Hi, I'm Michael Kolb, CFP and Portfolio Manager here at Evergreen Wealth Solutions, here to give you the quick 3 to 5 minute update for our outlook and positioning for April 2022. If you'd like a longer version, please feel free to listen to our webinar. So far, year to date has been rough for markets. Most major indices are down somewhere around 8% due to the invasion of Ukraine by Russia. Obviously, that's been a big shock to the market, or an outside or an exogenous shock that you can't really predict, but do happen from time to time. The market at one point in time was down about 13%, which is actually slightly better than average of 14% that normally happens intra-year. But we constantly need to remind ourselves that the market typically still ends up positive for the year. In fact, 32 out of the last 42 years have ended positive. But we need to look specifically at Russia and see what's happening and how that may or may not affect our portfolios. Typically, in situations where we have one country invading another, such as Iraq invading Kuwait or North Korea invading South Korea, you do have these very steep and swift downturns. However, they also do typically recover relatively quickly as well. And we can look at history to give us an idea of what this time might look like. Other areas of concern with this Russian invasion are things obviously like oil and gas and how they're affecting energy prices, but also things like precious metals and wheat and their production and how it may affect our global markets as well. The great thing is that we are not talking about COVID. For the first time I can remember in doing these webinars, we are not starting out with COVID and how it's affecting our economy. Now, we do have the Russian invasion, but the COVID numbers are down substantially. We might have another wave, it's possible, and there are other parts of the world like China that are being affected more than the US, but most of these are being pretty much shrugged off by the consumer, and they continue to spend at levels that are basically back to pre-pandemic levels. Other items of note in our webinar were consumer sentiment on the economy, which is at a low in the last 10 years. In fact, it's lower than where we were with COVID, which is concerning since that can drive a lot of different spending in the economy, but most of that is particularly driven by inflation. So we broke down a little bit of what might be transitory in the inflation versus more sticky. What are things like energy and new and used vehicle prices that are probably just a short-term pop versus things like travel and restaurants and shelter that might be a little bit more of a long-term stickiness. With respect to earnings, we expect another record-breaking year this year in corporate earnings as they continue to be able to weather the storm of inflation and low labor. And the expectations of both the market and the Fed have finally become aligned with regards to future rate hikes, which is good. Although on the downside, we have had a slight inversion of the yield curve. We don't believe that it's to the point where we need to be concerned yet. What it does mean is that we are actually able to get a little bit of higher yields for clients, even in the shorter end of the curve. Although with high inflation, those real returns are still negative. With regards to market valuations, the S&P 500 has come down from where it was at its peak. However, it's still above its 25-year average. Higher elevated PEs mean that you might be paying a little bit more for a stock, but at the same point in time, it is a lot lower than it was about a year ago. Dispersion has also shrunk or contracted during that time period, meaning that the price between the highest PE and the lowest PE has come down substantially. With regards to international markets, there could be a lot of more headwinds there as much more of their energy production comes from places like Russia, particularly in Europe. And we are to the point where the difference or the discount for foreign stocks is starting to look attractive, but we are still looking for trigger points before we would go overweight in that area. And finally, the investor sentiment for the market. And that is relatively bearish, but is still nowhere near the triggers that we would want in order to make market moves. So where does that leave us? Well, labor, earnings, all positive. On the other hand, we have sentiment and inflation from an economic perspective that are negative, but then we have things like financial conditions, equity valuations, credit valuations, the technical trends that are happening, and investor sentiment on the market that are all neutral. So what does that mean for you as a consumer? Well, make sure you meet with your advisor, understand what your long-term goals are, and whether or not these affect any of those long-term goals. As long as we keep that long-term perspective, we are going to make sure that we can accomplish them.